Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow in which we invest additional money on the first trading day of every week. They're the Dividend-Growth portfolio, which was started in 2021 and now has an annual return of 19.79%, and our high-yield stock portfolio, which surprisingly has a higher return of 29.1% per year. The high-yield portfolio was started in 2023. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year as outlined in red, and now has an annualized return of 39.04%. Like our dividend stock portfolios, the tech stock portfolio is our real-world investment portfolio where we make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can just go online to read more about them if you like less frequent trading. First, we'll do a quick performance overview. Our best performing classroom stock portfolio is our tech stock portfolio with an annualized return of 39.04% per year. In second place is our high yield stock portfolio, which now has an annual return of 29.1%, and it's handily beating the S&P 500 since the portfolio started. And our dividend growth stock portfolio, the original portfolio that we started, now has an annual return of 19.79%. Both of our dividend-centered portfolios are beating their true benchmark, which is the ETF with the ticker symbol SCHD, which we discussed later in the video. And later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it would require giving up some portfolio diversification. But depending how much diversification you require, that might be relatively easy to do, as our dividend growth stock portfolio currently has 105 holdings, our high yield stock portfolio has 36 holdings, and our tech stock portfolio has 25 holdings. So what is this slide showing? It's showing the portfolio value over time for our original portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,817 after 160 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. So we're buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of last year, we started August of 2023, we started a second portfolio, this time investing in the high-yield dividend-paying stocks. Now the tan line on the chart shows what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks didn't do well, and neither did bonds. And as you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November 2023. And I'll update our tech stock portfolio in next week's video, which we started in late April of 2024 and has been the best performing portfolio over that time. And for those who have been asking, all three of the portfolios are now on our website, which is beatthestockmarket.com. We post the stocks we're buying in real time on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. So as I mentioned, we're focusing on the two dividend stock portfolios in this video, and these are the portfolios in which we make additional investments on the first trading day of the week. Here's a look since our last video 2 weeks ago versus their benchmark. Our high yield portfolio narrowly beat out our dividend growth stock portfolio over the last 2 weeks, gaining 5.86% versus 5.83% for our dividend growth portfolio. I keep predicting that the return of the high yield portfolio will come down enough that the dividend growth portfolio will overtake it, but so far I've been wrong. Now both portfolios beat the S&P 500 over the last 2 weeks, but a better benchmark, a more realistic benchmark, is the very popular dividend ETF with the ticker symbol SCHD. Over the last 2 weeks, it gained 3.92%. Before we talk about our dividend portfolios in depth, let's look at what happened recently and what's coming this week. Earnings season has started and will last for about 6 weeks as most of the 500 companies in the S&P 500 will announce their results for the fourth quarter of last year. Anytime they release their quarterly reports, there's a lot of action going around those stocks on those few days. And you will see many of our stocks on our list we bought, and you will see on our list of stocks we bought last week that many of our usual chip companies did not make our buy list for the first time in a while because of large run-ups in their stock prices. Now next week, on Tuesday, Starbucks reports and is a member of our dividend growth portfolio. It'll be interesting to hear from the CEO who turned around Chipotle. I was reading a lot of analyst reports lately, and one that caught my eye was forecasting that Starbucks will be able to increase its dividend 8% per year over the next 5 years. Hopefully that's right, as the stock is due for a turnaround. On Wednesday, it's the FOMC decision about interest rate cuts that'll be announced, and I would be shocked if they cut rates. Many people were predicting far too many rate cuts for this year. Also, we'll hear about the fourth quarter results from Microsoft, Meta, ServiceNow, and T-Mobile, 2 of which are under the radar dividend payers that we added to this week, as you'll see later in the video. On Thursday, Apple will report, and many are expecting not such good report from them. So that'll be interesting to see. And on Friday, there is a PCE report, which is the Federal Reserve's favorite measure of inflation. PCE stands for Personal Consumption Expenditures. And that's going to have a big effect, or could have a big effect on the market if inflation is either a lot higher than expected or a lot lower than expected. Now, before we get into which stocks we bought last week, a lot of people have been asking me for my favorite books about investing. My 2 favorite books were the basis for the 3 stock screens I publish on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis for 2 of the 3 stock screens we publish on our website, beatthestockmarket.com. They are the trending value stock screen and consumer staples stock screens. I update the stock screens monthly, but of course you could get the books and learn how to do the screens yourself and save some money. So what's a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price to earnings, the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs in the book, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. And I put the 2 links to the videos, or to the books on Amazon in the description of the video. Because we're investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the most popular personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you're better off just using Excel to calculate it for you, and then use Quicken software to double check, which is what we do. Now in this video we talk a lot about our dividend growth portfolio and the newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed. Because remember, the dividend growth portfolio was started 20 months earlier than the high yield portfolio. The high yield portfolio was started in August of 2023, and the annualized return so far is 29.1%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 20.82% over the same time period, which includes, and the dividend growth portfolio includes way more growth stocks than the high yield portfolio. The high yield portfolio consists of a lot of deep value, what I would consider deep value stocks. I expect that the dividend growth portfolio will have the higher return over the long run, especially since the high yield portfolio has less than 0.5% of its portfolio in tech stocks. But we'll see what happens. I keep saying it's going to catch up, but so far it hasn't. Now, if an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income ranging from dividend-growth stocks, like Microsoft, to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for 17 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. The fact that the high yield portfolio is outperforming our dividend growth portfolio over the same time period is very surprising to me. I wouldn't think that it would be possible to get both a higher return and a larger dividend yield, but we'll see what happens over the long run. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio, our original portfolio. Our dividends for 2024 increased 56% over the dividends we received in 2023, and dividends for the latest quarter increased 43% over the same quarter a year ago. And the graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main portfolios? And even in our tech stock portfolio, the majority of them also pay dividends. The first reason we stick with dividend-paying stocks for our dividend strategies is, according to Hartford study, which should be updated pretty soon, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. Now, Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion, that being that dividend-paying stocks have both a higher return and less volatility than non-dividend-paying stocks. A second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. Why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. If you look at the tech stock portfolio, which we're not going to talk about a lot in this week's video, it has the highest return, but it also has the highest volatility. So some people can't stomach that, other people can. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks, as measured by beta and standard deviation, tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, BlackRock recently released a report showing that $10,000 invested in companies that grow their dividends or initiated a dividend grew to $2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now, the holy grail of dividend investing is having a stock portfolio that produces, one, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. First stock is Broadcom, which just increased its dividend for the second time last year and for the 14th consecutive year. I bought Broadcom, a chip maker, in 2020, just 4 years ago. I guess it's now 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we've constructed a very diversified portfolio. That's the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I'd started a dividend stock portfolio for the investment newsletter I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invest in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. And if you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted, and indeed they did increase a few months ago in November. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies and the tech stock portfolio, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my college accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my current brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck when I started the Dividend-Growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement account and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invests an additional 35 cents per week for a total of $12.09 per week instead of the original $11.74. For our Classroom Dividend-Growth stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, inflation was even lower in 2024, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 each Monday for the year of 2025. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our Dividend-Growth Classroom stock portfolio annual return is 19.79%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return will only be 10.17%, which is a 94% difference. Our high-yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying Classroom stock portfolios. I also prefer our actively managed Classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps, and that's not a good thing. So this slide shows our best performing stocks for our original portfolio, the Dividend-Growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore and Crane Holdings, have been sold. Our best performing stock so far has been Broadcom, with a 338.7% return in less than 3 years. Evercore, an investment bank, is at number 2 with a 252.9% total return. It's been sold. The fastest riser that is still in our portfolio is Bank of New York Mellon, which has more than doubled in 15 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown that they historically beat the market averages by a significant amount. So as you can see, F&G Annuities is an under-the-radar dividend payer, so same with Crane Holdings and Repositrac, as well as Finia and Prodosio Education Corporation. This slide shows our best performing dividend stocks since our last video 2 weeks ago for the Dividend-Growth portfolio. It does not include dividends. The best performers were Applied Materials at 11.9%, followed closely by Goldman Sachs at 11.8%, Morgan Stanley 11.7%, and at over 10% we've got KLA Tencor and Bank of New York Mellon, GE Vernova, and Medtronic, Nvidia, etc. And on this slide, we're looking at our best performing dividend stocks for our high yield portfolio for the last, I need to update this slide, it should say the last 2 weeks. So the best performers were Goldman Sachs again, Morgan Stanley, Bank of New York Mellon, American Tower, CVS Health, Medtronic, FMC, Lyondell Basel, WEC Energy. Even though this portfolio, the high yield portfolio, has a lot fewer stocks than our Dividend-Growth, it still had a lot of big gainers over the last 2 weeks. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence, which is a fancy way of saying do your own research. So on this slide, we would list any stocks we sold last week, but then we did not sell any stocks for our Dividend-Growth or our high yield stock portfolio. And we did buy 2 under-the-radar dividend payers. So 90% of our portfolio is comprised of high-quality Dividend-Growth stocks. That means someone who has a company that's been paying dividends for a long time and has been regularly growing those dividends. But the other 10% or so of the portfolio has been invested in under-the-radar dividend payers. So these under-the-radar dividend payers are companies that have just recently started paying a dividend. They tend to outperform the market, but they're usually smaller and therefore riskier. However, these two dividend payers are not small at all, Meta Platforms and T-Mobile. Both started paying their very first dividends relatively recently. Both appear to be undervalued, and both are in the communication sector. Now, our dividend growth portfolio is significantly underweight the communication sector when compared to the S&P 500, and I wanted to boost our allocation to that sector. I may occasionally continue to do this to invest more in Meta and T-Mobile. We'll see, though. Now let's talk about the dividend growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 of the 15 stocks. Now we've purchased the first 10 stocks on the list that are not in yellow highlight. Stocks in yellow, in this case Microsoft, have already grown to be 4% or more of the portfolio. So when that happens, we don't invest any more in that stock, because we want to build a more diversified, less risky portfolio. Thermo Fisher remains at the top, but 3 chip stocks that have been on the list a lot recently, those being Lam Research, Applied Materials, and KLA-Tencor, did not appear on last week's buy list at all, because they had had such a huge run-up in price that their margin of safety falls just short to be on the list. So either their stock prices will need to come back down a bit, or analyst earnings estimates need to increase for them to get back on the list. Those are the two most common reasons they would be back on the list. So good old boring A.O. Smith made the list again. I recently read that analysts expect the pure play water technology company will be able to raise its dividend over 22% over the next 3 years. Hope that happens. Remember, we use many criteria to filter stocks, and if they're hovering near a required level, they can make the list 1 week and then drop off the list based on a small movement. Examples of criteria used to filter out stocks include the aforementioned required margin of safety, and also consensus earnings growth estimates over the next 12 months, which tends to change frequently. For consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. And you can't keep increasing your dividends if you're not growing your earnings. So a stock might have a 5.2% estimate 1 week and make the list. But the next week its estimate could dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. So each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in a Fidelity brokerage account. Now this week we did buy 12 stocks because we bought the two under-the-radar dividend payers, being T-Mobile and Meta. But usually we just buy 10. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the top 10 stocks as shown on this slide, we combine the weekly deposits with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it up amongst the 10 stocks we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top 10 stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. Now, this table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends. And our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing these dividend growth stocks and the high yield stocks in the next few slides. This week, or last week, I purchased over $2,900 of the stocks from the dividend growth, high yield portfolio, and the tech portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF, SCHD, and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. As I mentioned before, the other 10% so far have been invested in usually smaller under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they're usually smaller companies, but studies suggest that they historically beat the market averages by a significant amount. Now, those two under-the-radar dividend payers we bought last week are Meta and T-Mobile, and they're huge companies, and they do have very high quality ratings. So they are not in the extremely risky category. So risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate companies' management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in companies' accounting practices, as well as the quality or reliability of their reported earnings. And earnings is just a fancy word of profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. And here are our trade confirmations from last Monday for the dividend and growth stock portfolio. We took the weekly deposit plus any dividends that had recently been received, and then invested the total in the top 10 dividend growth stocks plus the two under the radar dividend payers being T-Mobile and Meta. And remember, we skipped Microsoft because it consists more than 4% of the portfolio. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some potential, for those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's return. Number 1, each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5 or maybe like 1 through 6. However, the downside is this reduces portfolio diversification. But some investors are comfortable with a more concentrated portfolio. So far, investing in only the stocks ranked 1 to 5 would have improved annual returns 75.2%, but I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Normally, if a stock's allocation in the portfolio is 4% or greater, like Microsoft, I won't purchase more of that stock. This technique reduces a portfolio's risk by ensuring the portfolio doesn't become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very well diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses plus generate extra income for vacation, travels, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a high risk for tolerance, However, an investor who has a higher risk tolerance and therefore does not mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's return, especially if the company's in the top 5 of that week's ranking, as mentioned in bullet point 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved annual returns by 27.5%. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers like Meta and F&G annuities and T-Mobile, despite having some incredible performers like the aforementioned F&G annuities 119% gain in 12 months and Repositrax's 97% gain in the same time frame. On average, they've not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. Now, one possible reason these stocks haven't done quite as well as the dividend-growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, Sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell often in the portfolio and tend to only sell if the company cuts the dividend or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we're buying. The downside would be higher turnover, but this could boost your portfolio's return by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this fourth strategy is the most difficult to implement because you have to implement your own valuation methodology. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there is no hard and set rule that says you have to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our Dividend-Growth stock portfolio, I originally started investing $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week is you get more diversification. So if one doesn't mind less diversification in their portfolio, option one is to invest every other week or monthly instead of weekly. Now, option two is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. In other words, skip the under the radar dividend payers and then hold the other ones forever. Over time, some of those stocks will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Now, historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, Air Products and Chemicals announced another dividend increase last week. This marks the 43rd consecutive year of dividend increases for this dividend aristocrat. So the last 22 dividend increases for the portfolio have had an average of 8.3%. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once a stock split has occurred. And here's a look at the top 10 stocks that make up the largest portion of the Dividend-Growth portfolio as of Friday after the market closed. American Express is still in the top spot with 3 of the first 4 slots going to credit card companies. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest in one single stock. Aggressive investors might not want to limit the investment in any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we'd always invest in our top 10 stocks, regardless of the size of the stock portfolio allocation, but that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible, and I've seen this happen many times. Now, our portfolio holdings are at 105, with 90% of the weighting being in the high-quality dividend growers and 10% of the portfolio's weight being in the under-the-radar dividend payers. We usually make far more additional investments into the dividend growers than the under-the-radar dividend payers. So far, around 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying stocks that are trading at a discount. Now, that might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes obvious when to sell a company once we download company and financial accounting information in the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that was time consuming was creating the spreadsheet. It was quite the beast. It took about 2 years to make. All right, let's talk about the high yield dividend paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into a separate portfolio, and those are stocks with higher dividend payouts. The portfolio as a whole had an annual total return of 29.1%. Since the portfolio has been in existence for 17 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which was started 20 months earlier. Currently, the high yield portfolio's dividend yield, if you bought everything now, is 4.14%. But the companies in it likely won't grow their dividend as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in this portfolio have increased their dividends and we've been able to sell some stocks high and reinvest into better bargains, pushing the portfolio's yield based on the amount we've invested to 5.04%. Now, two strategies are being implemented in this portfolio, as you see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 18.4% and has been held for an average of 201.5 days so far, which is an annualized return of 35.95% using Excel's rate function. Now, it's not likely the portfolio can keep an annual return that high since stocks historically average 9 to 10% each year. I keep saying that, but it's still staying pretty high. Now let's talk about the high-yield dividend-paying stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the 8 stocks. And because the high-yield stock portfolio currently has less than 0.5% in tech stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off, so don't chase yield. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1, like I mentioned before, emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought last week while implementing Strategy 1 are Bristol-Myers, PepsiCo, Sony, and UPS. And the 4 high-yield stocks we bought last week while implementing Strategy 2 are Sony Group, PepsiCo, PNC Financial, and Merck. As for Pepsi, I was reading a recent analyst report that projected that the company will grow its dividends 7% per year over the next 8 years. And if you look at the yield, it's already really good, 3.7%. So if they can continue to grow it at 7%, that'd be awesome. And here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that had recently been received and then invested the total funds into the 8 stocks from our buy list. All right, that's it for this week. In the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies you would like to see more of. And finally, here are the places you can reach me: YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. I'll see you again next week with a list of tech stocks we'll have purchased on Monday. See ya.